Up until the 1980s, the government ran the generation, transmission, distribution, and supply of electricity to households. Privatization of the energy markets was introduced in the late 1980s to encourage competition and innovation. We now have the wholesale market, the place where generators and suppliers trade electricity. Electricity is settled in half-hour blocks called settlement periods. The GB system operator, NESO, receives the outcome of the wholesale market, who does what in which settlement period, via final physical notification from the generator and supplier at gate closure, which occurs 1 hour before each settlement period. This ensures that supply matches demand and keeps the lights on. Suppliers must forecast the amount of electricity their customers will use and purchase the electricity in the wholesale market. The forecast is based on their expectations of demand growth, geopolitical tensions, and renewable energy growth. There are two ways in which the buying and selling of electricity can occur. One, over-the-counter bilateral deals. Two, a central exchange. Firstly, suppliers need to supply the baseload. These are 24-hour power products to meet the minimum level of demand for their customers. Then, to meet the higher level of electricity demand forecasted for specific hours of the day, suppliers need to secure peak load products. To ensure reliability and security, over 90% of electricity is traded weeks, months, and years ahead of delivery via contracts called futures and forwards. These are contracts arranged between suppliers and generators who agree to buy and sell electricity at a locked-in price in the future. Suppliers use this to secure the bulk of electricity to meet customer demand, while generators receive guaranteed payment for the electricity they produce. For example, a 50-megawatt solar farm agrees to deliver all of its generated electricity to a supplier in August 2025 for £45 per megawatt hour. Once agreed, the solar farm will receive that price from the supplier, regardless of volatile market prices that change every half an hour. Futures are standardized contracts that can be traded on an exchange. The futures curve shows that prices that market participants pay today for the electricity to be delivered at a point in the future. The futures curve is a current snapshot of what market players are willing to pay. This price is influenced by factors including the forecasted demand and supply, fuel prices, and market sentiment. Forwards are bespoke contracts traded over the counter by brokers and offer more flexibility in terms of contract duration and delivery period. For example, a generator may agree to deliver electricity for £30 per megawatt hour between 10 and 2 p.m. for a month, and £60 per megawatt hour between 2 and 6 p.m. for that month. It is important to note that these contracts do not necessarily require the physical delivery of electricity. Traders also often use these contracts to make profits. For example, they may buy a futures contract for £60 per megawatt hour, expecting that electricity prices will rise closer to delivery. Let's say the price rises to £80 per megawatt hour. The trader will be able to sell the contract £80 per megawatt hour to a buyer and make a profit of £20 per megawatt hour. Conversely, they may sell a futures contract for £60 per megawatt hour with the expectation that electricity prices will fall closer to delivery and buy the contract back for a lower price. The closer it gets to the delivery period, the more accurate demand forecasts become, and suppliers may need to procure additional power. This is known as adding shape. Electricity is procured for finer granularities across hourly or half-hourly blocks. Trade occurs on the day-ahead and intraday markets, known as the spot market. In the day-ahead market, electricity is traded for delivery the following day. This market is called Nord Pool in the UK. In the intraday market, electricity is traded for delivery on the same day. This market is called Apex. These markets are physical, but participants can still trade physical positions. For example, a battery is scheduled to sell electricity through the day ahead market at £200 per megawatt hour at a specific time. It can choose to buy a position in the intraday market at £40 per megawatt hour, therefore releasing its position in the day ahead market, making a profit of £160 per megawatt hour without the need to physically deliver power. Here you have it, the ins and outs of the wholesale market. To find out more about how well the current wholesale market system is working, check out my other two videos on the problems associated with the wholesale market and one of the previously considered reform options, zonal pricing. Although the UK government recently finally decided to reject zonal pricing.